In this video, we want to talk about divergences in trading. What are divergences and how can one make money? How can one stay on the right side of the market trading a divergence? So, to understand divergence, you have to add an oscillator to your chart. You could use the relative strength index, you could use the CCI. For this exercise, I have added the RSI 21 period to a chart of Bitcoin 4 hour. So, have you noticed that the price and the oscillator they travel in the same direction? You can see here price is traveling downwards and the oscillator also travels downward, and when price uh, goes up, the oscillator also does the same. And for this swing down, the oscillator also swings down. And here where price swings up, the oscillator also swings up. So, but the difference is while the oscillator mirrors the trajectory of price, the destination where the swing points are formed are different. Like you can see in this example here, over here price has made a lower low, but the oscillator made a higher low. This is a divergence in price. So these are points of reversal. Looking at it from the perspective of Elliott waves, divergence, whichever type it is, a divergence signals the termination of a wave or a subwave. A divergence signals the termination of a wave or a subwave, and when a wave or a subwave terminates, price reverses. Though it does not give a guarantee of how deep or how long the reversal would be, because if a divergence forms after the termination of a motive wave, the uh, reversal is going to be a corrective wave and vice versa. So while a divergence does not give a guarantee of the length of the duration or the depth of the reversal, the depth on using the Fibonacci of this. So while it doesn't do that, it's at least signals of determination of the previous wave. So there are different types of divergence. We have the regular and the leading, and the difference between the regular and the leading is in the regular divergence, whether it's bullish or bearish, price always makes a new extreme, a new price extreme. In the case of the bearish, the price is making a higher high while the oscillator is making a lower high. And in the case of the bullish, the price is making a lower low while the oscillator is making a higher low. However, for the hidden divergences, the price makes a lower high while the oscillator moves differently. So I'm going to share with you a few examples on the charts. This is a recent price action. So you can see we have a divergence here on a Bitcoin 4 hour chart. We have a divergence here on the April, a bullish divergence. That's the bullish ones. I highlighted them in blue, and the bearish divergence I highlighted them. You can see this this is a regular divergence because the price formed a lower low while the oscillator formed a lower high. And same thing here, this is also a regular divergence because the price formed a lower low while the oscillator formed a lower high, and this is also a bearish regular divergence because the price formed a higher high and the oscillator formed a lower high. In Elliott waves, this is the point, this is a motive wave one, two, three, four, five that's terminated here. This is the start of the corrective wave. This is wave A, this is wave B, this is wave C that corrected and terminated here. So as you can see, price moved up after it. So this is a simple A, B, C formation. For the C, you can see the five waves clearly. This is one, two, three, four, and five, two, three. So also I highlighted some here on gold. You can see we also have the same thing here, irregular divergence, and same with the previous example. The regular divergence here is the termination of the B wave of a corrective formation. You can see this is A, B, and the C wave corrects downward. And here you also have regular divergence, another ABC upwards, you can see. So here, what do we have? We still have a regular divergence, but here we have a hidden divergence. You can see here in gold, gold had the hidden divergence printed with price having a lower high while the oscillator having the higher high. So this is hidden divergence. So divergence is a powerful tool if you can combine it with your existing trading strategy. It can help improve your performance significantly. So in the next couple of videos, we're going to be creating uh, an expert advisor, a trading robot that identifies divergences on the charts and can execute trades, but we're going to have to combine it with other trading strategies because we will not be treating this as a standalone strategy. So see you in the next video. So don't forget to like, comment, and subscribe and share with your friends too.